Let's start with the macro. Who knows what's going to happen at these peace talks in Turkey? Let's hope for the best possible outcome. The war at some point will likely end, or I guess maybe drag on, but let's say we get an ending to the war, hopefully very soon. What happens to markets? Have you guys done any analysis on this? Do stocks rally, bonds sell off, oil falls, or does the market continue to roll on as long as the sanctions are there? What do you think?
Listen, I think it would be clearly welcomed by financial markets. I think it would be great news. I'm not exactly sure that sanctions immediately come off. So to the extent that it still feeds through to inflation, I think that's going to continue to happen, and you're probably going to see higher inflation prints for the next couple of months as a result of that. But I do think it at least allows us to kind of move on from it as far as the mindset as an investor. So I think it'd be cheered by markets. I think it'd be a good thing. But again, how much supply chains are still disrupted by it is the big question. And I think that's going to take a lot to clear.
Yeah, maybe markets like wheat, it does help, but others like oil that are still sanctioned, it does not. So inflation, to your point, may remain hot. You probably heard me reference that slight inversion of yields on the 5-year Treasury and the 30-year Treasury. I know not as closely watched as the 2-10 or even the 3-month T-bill, but it did happen. First time, Shawn, since March of 2006. And when something happens for the first time in 16 years, it gets our attention. Does it matter to you?
Absolutely, it matters. The yield curve has a tremendous record of being a predictor of recession. It inverted, I think, May 2019, and we got a recession, almost a year later. Now, it was related to COVID. It wasn't policy induced, but it still got it right. So it matters a great deal. One thing I would point out to investors, though, and I think this is really worthwhile to know, is that even when it does invert, and if you do get a recession, it tends to take a while to form, a year or two. So maybe, say we are headed towards a hard landing. I'm not sure that's the base case. I think odds are we probably aren't. But then your possible timing would be March 2023, March 2024, somewhere in there. So we certainly have to pay attention to it. And it's not the only flashing signal, right? There's a peak in consumer confidence that we saw, also kind of a peak in the number of small businesses saying that now's a good time to expand. Those are two potential signals as well. So it's not just the yield curve.
Well, should we have confidence in the Fed, Shawn? I mean, you referenced it about the so-called hard landing. Here's the reality. Your own research notes that in a number of the past inflationary cycles where core inflation was as high as it is now, which you got to go back really to the mid-70s and early 80s to find that, the Fed was successful, quote, in bringing down inflation, but only because the economy went into recession.
Right. Yeah, so the Fed actually does not have a terrible track record when it comes to soft landings. They've done it before. They did it in kind of the mid-1960s. The early 1980s, and then kind of the early to mid 1990s. So it's possible, but inflation was lower then. And if you look at what happened during January 1977 and then kind of through, I think, April 1980, they had a really strong Fed tightening cycle. They raised interest rates by 1,300 basis points to try and combat inflation, and core inflation actually rose by 3% during that period. So their track record of beating inflation is not quite as good. Just in 9 of the last 11 Fed tightening cycles, core inflation rose through the cycle and only fell when you actually had a recession. If there's a silver lining, though, maybe global supply chains aren't as disrupted as we think, and maybe inflation still proves transitory. I know you get criticized for saying that word, but it could be a tailwind of the Fed. Let's hope.